G'day everyone, Greg Canavan with you for a Rum Rebellion market update. It's been about 10 days since my last update and I wanted to touch base with you and discuss some of the market happenings since last week's news, where the Fed has basically done a bit of an about turn, said they're on hold in terms of interest rate rises, and as far as their balance sheet shrinkage, or what they call quantitative tightening, that's going to end later on in the year with their balance sheet still around the $4 trillion mark. So essentially what happened last week, the Fed just said they're done raising interest rates. Initially the market was a little bit bearish about it, sold off, then it rallied. In the last couple of days we've seen some more selling. So I wanted to run through a few charts to give you a bit of an idea of where maybe the market's positioned at the moment. As you know, I've been talking about markets turning over, turning down after a strong rally at the start of the year, and I think that's still what we're seeing in terms of the evidence we've got in the charts. So the first one I want to show you today, probably one of the most important charts, is the US 10-year Treasury yield. So we'll have a look at that. The interesting thing about that, since the Fed has decided to go on hold, you've seen the yield there fall even more sharply. Now, falling yields indicate a slowing economy. So what this chart is telling you is that yes, the US economy is more or less at a cyclical high point, or perhaps was in 2018, and is starting to slow down. The Fed's essentially confirmed that by saying that there's no more interest rate rises, and the bond market's telling you that the economy is slowing, and when that happens, yields fall. The next chart that I want to show you is the US dollar index. The reason why this one is important, when the US dollar is strong, that tends to be an indication of, I guess, tightening liquidity in the global economy. Now, as you can see from this chart, the US dollar index has been rising since the start of 2018. As you can see by the moving averages there, the red and the blue lines, they've been moving up in an upward trend. And while the US dollar index has been tracking sideways probably for the past 6 months, that trend is still in an upward direction. So really what that's saying there is the recent move by the Fed hasn't made any real difference to the US dollar index there. And that's just a reflection of the other major global currencies like the yen and the euro, and probably to a lesser extent the British pound. They are not decent alternative assets for big money to move into. So the US dollar, even though the Fed's on hold now, the US dollar is still looking strong, and that's indicative of I guess some bearishness about the global economy, and obviously a bit of concern about the US economy. And just to underscore that point, I raised the issue last time we went through a couple of these charts. I think it was maybe 2 or 3 weeks ago, and I pointed out an issue, or I guess a theory, Dow Theory, which compares the Dow Jones Industrials chart to the Dow Jones Transports chart. I want to give you an update on that today, because that, in addition to, I guess, the charts I've just showed you, also confirms that the US economy could well be slowing here, and we're in a cyclical slowdown. So let's bring up the Dow Jones Industrials chart. As you can see, that doesn't look too bad. It's sort of gone from a very sharp down sell-off at the end of last year to a strong rebound. The moving averages there have turned back up, and the index is bouncing off the 50-day moving average, which could be considered, a reasonably bullish move. But if you think about the industrial average is meant to I guess denote the amount of production that's going on in the US economy. So what this chart is saying is that production levels are still quite decent, but then if we move over to the transports chart effectively show you how that production is being moved around the economy in terms of the distribution of the production of goods. Now this chart doesn't look as quite so bullish, and as you can see, the moving averages never really crossed over in a bullish manner, and while the transport index did rally strongly at the start of the year, it started to turn back down at a point where the moving averages didn't cross over. So that's telling me that the US economy, even though it's still producing goods, the product or the distribution of those goods is not consistent with the production, which in some measures or in some ways could indicate that there's an inventory buildup, because you're not seeing the goods distributed and consumed around the country. So that's something to keep in mind for the future. If inventories build up at some point, production is going to have to be pulled back a little bit to see that inventory run down, and that could be something we'll see in the coming months. Okay, next chart I want to show you here is the ASX 200. This is the Aussie market. You're probably pretty familiar with this one. We've seen a really strong rally, and at the moment the pullback's nothing out of the ordinary. Even though I've been saying I think we're near a market peak for a little while now, you could still be quite bullish about this chart, and that really is all about the strength in the resources index, which is the next chart I want to show you here. As you can see there, that broke out to new multi-year highs in January, February, and it's still holding above that breakout level. So while ever the resources index can maintain that strength, I think the Aussie market looks quite strong. But just flicking back quickly to the ASX 200, most of that move, you can really put that down to the strong move in the resources stocks, especially BHP and Rio. They're trading up around multi-year highs thanks to China stimulus and iron ore, coal prices, which are still quite strong. But the question is, how long can that be maintained? And just to sort of, I guess, bring China into it, the last chart I want to show you here is the Shanghai Composite Index. Not that this is a particularly good reflection of the Chinese economy, but it does give you a good indication of the I guess the amount of liquidity that is in the Chinese economy. And it's well known that at the end of last year, early this year, Chinese authorities unleashed another round of stimulus into the economy. A lot of that clearly flowed into the stock market. Very strong rally, but now I'm just wondering whether that rally might be starting to falter a little bit. That 3,000 point level is quite important. On the Shanghai Composite there, we just closed slightly below it yesterday, recording this on Wednesday the 27th of March, so yesterday being Tuesday, and it'll be interesting to see in the next week or so whether the Shanghai index can maintain above that level. If it starts to turn back down, it might be an indication that the liquidity or the stimulus boost is starting to wash through the Chinese economy, and that could have implications for the Aussie market in the months ahead. So that's a wrap for today. Still, I guess, reasonably uncertain about where things are going to go. My view remains the same, that we are in a process where the market's turning down thanks to the global economic cycle turning down. And to get some real momentum for shares, the Fed's really going to have to turn around and go into easing mode again, but I don't think that's likely. So anyway, we'll see what happens, and I'll catch you again next week. Thank you.